For decades, the conversation around true wealth has been trapped in a simplistic binary: risk versus security. We've been taught to revere a few traditional assets as the absolute guardians of our financial future. But what if one of those sacred cows, one of the oldest forms of value storage known to humanity, is quietly underperforming? What if the path to long-term, exponential growth lies not in the vault, but in a simple, accessible investment that most people still overlook? This isn't about choosing a good investment over a bad one. It's about understanding the subtle, yet massive differences in two investments that are both, in their own right, powerful. This is about making a wise choice, not just an easy one, because every decision we make today carves the shape of our tomorrow. The quest for financial clarity often begins with a single question: where do I put my money? The answers usually lead us to familiar territory: physical gold, shining and tangible, or the modern digital realm of exchange-traded funds, or ETFs. Welcome to the Wealth Up Hub, where visionary mindsets turn into real wealth actions. Your future self thanks you. To truly grasp the power dynamics at play, we have to look beyond the headlines and dive deep into the numbers, the cold, hard facts of market history. Let's take a 30-year journey, starting in 1995 and ending today, in 2025. Imagine you had an initial investment of, say, $10,000. If you had invested that capital into physical gold, by 2025, your investment would have grown substantially, perhaps to around $54,000. That's a respectable return. It's a powerful hedge against currency devaluation and an anchor in times of global uncertainty. It's certainly a far better choice than simply letting that money sit in a traditional bank account. But here's where the story takes a fascinating turn. If, instead, you had put that same $10,000 into a broad market index ETF, tracking the S&P 500, that same initial investment would now be worth over $96,000. That's a difference of nearly double the final value, a gap of tens of thousands of dollars, all stemming from a single 30-year-old decision. The returns are not just slightly better, they are exponentially superior. This stark difference forces us to confront a vital question. Why is this happening? First, we need to address the supply dynamic. Gold, while finite on Earth, is still actively mined. Every time a new gold reserve is discovered and extracted, the global supply increases. This constant, albeit slow, growth in supply acts as a subtle gravitational pull, tempering its long-term growth potential. Contrast this with truly scarce assets, or, more importantly, with a collection of the world's most innovative, profitable companies that make up the S&P 500. These companies are constantly adapting, innovating, and generating new revenue. Their value is tied to human ingenuity, not just a geological constant. This brings us to the indispensable principle of investing: diversification. While gold is an excellent store of value and a non-negotiable part of any balanced portfolio, placing too much of your faith and your capital into it limits your growth. A portfolio that relies too heavily on gold is an insured portfolio, but perhaps not a flourishing one. The key takeaway is this: you should own gold, but you must not over-rely on it. The long-term risk profile is also illuminating. When we talk about risk, we often worry about losing money tomorrow. But seasoned investors focus on permanent loss of capital. In the short term, both gold and ETFs are volatile, but history offers a powerful reassurance about the stock market. Research shows that if you had held an investment in the S&P 500 for a period of 20 years or more, the likelihood of losing money, that is, the chance of your return being negative, historically drops to 0%. That's not a guarantee, but a compelling historical fact. It shows that for the patient, long-term investor, the perceived volatility of the market is largely negated by the consistent upward trajectory of human progress and innovation. Finally, even if your emotional attachment to gold remains strong, the desire to own a piece of the commodity, you don't have to choose the cumbersome path of physical bars and queuing at an office. The financial world has evolved. You can invest in gold ETFs, such as GLD, which track the price of gold without the hassle of storage and physical logistics. These instruments offer liquidity, ease of transaction, and superior transparency, often holding tens of billions of dollars in assets, a testament to global investor trust. The real power move is to learn, to research, and to be brave enough to step into the world of strategic, diversified, long-term wealth building. The facts compel us to a clear conclusion about strategic wealth building. Before we close, here's a summary of the critical differences between physical gold and broad market ETFs. Historical growth. ETFs tracking the S&P 500 have historically delivered nearly double the return of physical gold over a 30-year period, 1995 to 2025. Supply dynamics. The supply of gold continuously increases through mining, which naturally caps its exponential growth, whereas stock market index value is tied to the infinite potential of human innovation. Long-term risk. Historical data suggests that holding a broad market index ETF for 20 years or more offers a 100% chance of a positive return, effectively eliminating the long-term risk of capital loss. Access and ease. ETFs are generally easier to purchase, more liquid to sell, and eliminate the logistics and storage risks associated with physical ownership. Remember, fortune may come from things beyond our control, but what is in our control is the action we take today. So if you found this video helpful, don't forget to like, subscribe, and share, because like and subscribe are in your hands. Thanks for watching. I'll see you in the next one. The Wealth Up Hub, level up your wealth.